I can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story, Charles Schwab drops a bombshell, and you're not going to believe what they just said. In fact, we're going to put it to the test today. I'm going to show you the data to see if you agree with what they see is coming. Now, let's over to Bloomberg, where he picked today's story up with a headline, as U.S. payroll and wages surge, likely keeping the Fed rate on hold. And we got this staggering number today that non-farm employment jumped a whopping 353,000 last month. This blew out all expectations. Even this, the average hourly earnings jumped a whopping 0.6%. But meanwhile, something deep in the report that many didn't even want to admit is hours worked fell. And that was the surprising part, is they fell a large amount. So this payroll report has a lot of questions into it. How is it that you can get hours worked to drop? Meanwhile, you see a bunch of hiring. And I want you to put yourself in the position of an employer here. If you saw demand go down where you were cutting hours for your employees, would you hire a whole lot? It doesn't make sense any more than it makes sense what Charles Schwab had to say. It certainly justifies the Fed staying on hold. This from Kathy Jones, from Charles Schwab, chief of fixed income strategist. The economy is strong enough to generate a high level of jobs and hourly earnings, running at 4.5%, which suggests potential inflation from demand to many at the Fed. And this is a big fear of the Fed, is that what you're going to see is wage growth go up, and that means prices are going to go up as more workers get back into the workforce and go out and consume. But something here doesn't add up. If you're cutting hours, why would you give your existing workforce a big raise in terms of income? At the same time, you're hiring more people. It just doesn't make sense. But is this enough to get the Fed to hike rates or keep rates higher for longer? Well, that's what we're going to put to the test. The Blockbuster report highlights a labor market that's been instrumental in powering consumer spending and keeping the economy on its expansion path. At least that's what we've been told to believe, that in order to achieve this mythical soft landing that the Fed is hoping to engineer for the very first time in history, they need to bring inflation down without impacting the labor market. And based on what we've seen from the consumer price index so far, it looks like it's working. They're bringing inflation down. And then when you factor this payroll report, well, if you believe that it's true, well, it looks like the labor market is stronger than ever. The data raises questions about the gradual downshift in the pace of hiring that had tempered wage growth and helped bring inflation down, suggesting that all of the surge in hiring means employers are now doling out bigger and bigger pay increases. But that's until we get into the report, and we'll show you it doesn't all add up even close to what the headline suggests. But if we look at the payroll report, it does bring a lot of questions. One of them is the accuracy of this report. As we look at total non-farm, and this is a change in thousands of persons. So this is exactly how it's reported to us. You see this in blue. And I've overlaid the job openings and labor turnover survey. And you may remember, this is the former Fed chief Janet Yellen's favorite report. She would talk about how she loved the JOLTS report because what's nice about it is it actually gives us some sort of prediction of where payrolls are headed. Even though even that report is subject to its accuracy, that what we can see here very clearly is where job openings go, payrolls follow. And it makes a lot of sense, because if employers are cutting back on their job openings, well, it means demand is going down, and they're likely at some point in the months to follow come out and lay people off or hire fewer people. It makes perfect sense. But what doesn't add up here is the recent data. Now, I've had to trim off the pandemic data because it skews the report where you couldn't even see the lines here. But notably, the job openings labor turnover survey only went up a little bit. In fact, continues to be on a slow downward trend. And here you see this big jump in payrolls, and it doesn't make sense. What is going on here? Why would employers start hiring a bunch of people at the same time they're cutting hours for the existing workforce? Something just isn't adding up here. And while Fed officials are hoping employment growth will remain strong enough to keep the economic expansion intact, that is the hope here, they would like to see more moderate pay increases as they await confirmation that inflation will keep slowing to their 2% target. And if you read that right, it means exactly what you think it does. It means they don't want you to see big wage gains. They want you to stay on the edge with inflation so that you spend less, and that brings inflation down. That is the objective goal of the Fed. But one thing we can say that should be continuing on its growth path, well, that's your trading account. Now, I've got a big update on reports. Those of you who have been wondering what's going on, why aren't the new ones here? Well, I met with a programmer yesterday. There was a little bit of communications error. I got a preview of that. They're working. One of them we had to fix. We should have them in a few days. We're going to run a trial for those of you who are subscribers. I'll put them on the website as he sends them to me if they look good. But let's review one of our recent trades on CTA Timer Pro. Now, what's great about this is it looks at the machine positioning, and this is very unique because there's virtually no one else doing anything like this report, and absolutely nobody else running historical overlay like we do. And what's great is we tell you when it comes off these extreme positions, and coming very soon in a matter of days, we're going to show you when these moves happen, because that's where you want to buy. Looking back here on November 3rd, then we've got a Momentum Timer Pro report that comes off of the technical data. So we look at things like the RSI and the MACD and all those other tactical indicators. We smooth them all out. We add some proprietary data to it, and we get one clear signal. Here we see on November 3rd, you see one buying count after a period of string of sells. This was the indicator you wanted. That would have had you buying right here at this little green candlestick. And right now, you'd be up 13.9%. And you can jump on these reports. I put 3 coupon codes for a free month for each of them because I want you to sign up for them. I want you to try them out. I want you to trade them, because when you find out, like all of our other subscribers, how successful you can be trading, be a subscriber for a long time. But one thing we're not subscribing to is this payroll report, because let's look at some more data here. When we look at the consumer price index, because this is what the Fed is saying that we are winning the battle on. We're bringing inflation down without impacting the labor market. But now let's look at the details here, because we see in the report the 0.6% increase in wages, and that's hot and that's huge. And what you're going to hear is political elites say, look what we're doing. We're giving you pay increases so you can stay up with inflation. And then you're going to hear the Fed say, well, we're bringing inflation down. Look, your wage gains are going up. You're getting ahead for the first time. But the real issue here is when you factor in hours worked, which absolutely crumbled in January. Well, total compensation, as you see here, of average hourly earnings multiplied by average weekly hours of production to non-supervisory employees outright crashed in January. That's on a year-over-year rate of change. That tells us that this wage increase was meaningless because so few hours were worked relative to the prior month. It means, of course, inflation likely to come down at the sacrifice of the labor market. So we look back to what Schwab was saying is, look, hey, this is going to keep the Fed from cutting rates any sooner than we think. It's going to means the economy's hot. It doesn't mean that at all, because everyone's looking past this detail that hours worked came way down. And we're not looking for a weaker labor market. This from Fed Chair Jerome Powell on Wednesday. After the Fed left interest rates unchanged, we're looking for inflation to continue to come down as it has been coming down for the last 6 months. And that is what's happening. What he can't see is on this prior chart. And let's go back to that and take a look. It is indeed the labor market that's bringing inflation down, because total compensation growth is falling. And if workers cannot afford to spend money, they don't. And that means demand comes down. And this is the part the Fed can't see, because they're going to fixate on this non-farm payroll report. In fact, on Sunday, the Fed chief is going to be speaking on 60 Minutes, and you're going to bet he's going to be bragging big time about how he brings inflation down. And yet, look at the strong labor market, look at wage gains. But the details here, they don't make any sense, because when we start to look at the Fed's move here, we come back to what Schwab had to say about this is going to keep the Fed at rates higher for longer. Well, that's not exactly how it works. We can go back in time and look at the federal funds rate against total compensation, and we can note that the key part here is total compensation has so much to do with inflation that what you could see in the past, in the 60s and 70s, total compensation was coming down, which meant inflation was going down as demand went down. And what happened? The Fed followed too late with the lag. And you notice that all the way through the 70s into the early 80s, and these mistakes caused massive recessions and very long recessions. And with the stock market hitting all-time highs again, at least the S&P today, this is something that most investors and most consumers, they would just shake their heads and say, that's not possible. But again, as you're about to see, the Fed is making the exact same mistake it made then. Because in the 80s, well, they got a little bit of a clue and said, hey, wait a minute, when total compensation is going down, well, maybe we should cut rates. And sure enough, they did that without a big lag. You'll notice now into the 80s and 90s and even in the 2000s, even though we still had recessions, and yes, they were bad, the Fed was at least cutting. Until now, you'll notice the total compensation is just crumbling like it did in the 70s. The Feds got their head in the sand here saying, look, we think everything's fine. We don't want to cut rates because inflation might cut back. Did you just see that you got more income? It went up 0.6%. Of course, Fed can't understand. If you cut somebody's hours, it doesn't matter if their hourly rate went up, but if they're working fewer hours, their total pay goes down. And the monthly employment report is made up of two surveys, one from businesses and the other from households. This release included a yearly update to the establishment survey that produces payroll figures. In fact, the benchmark revision painted a slightly better picture of monthly job gains, suggesting that maybe this report also has something to do with the historical revisions, giving everyone a lot of excitement about just how strong the U.S. labor market is. But if it was so strong, why do we continue to see a decrease in demand? Again, you start to look at the data the government's putting out here, and things just don't add up. In fact, Bloomberg's economist said the most important part of January jobs report was the revisions. And they tell us the job market was hotter in the second half of 2023 than was apparent in real time, suggesting that the real-time data was perhaps more accurate than the lagged government data. If that's accurate, well, which we'll put to question as it isn't, it suggests upward pressure on wage growth will persist and it will be more challenging for the Fed to cut earlier this year. We may therefore change our base case to a rate cut in May. Of course, it's that change that drove the bond market. We see interest rates up today and bond prices down on the fact that the rate cut now is getting pushed back. But the idea here is the labor market is strong. But again, it doesn't make sense. Why would an employer give out higher wages to his existing employees, hire a bunch of employees, and then cut hours? It doesn't make any sense. And that's the problem with this report, is it just doesn't work. As the figure was likely boosted by a decline in hours worked, we finally get to the answer here. The survey week for January jobs report corresponded with a stretch of severe winter weather that roiled economic activity across a number of U.S. regions. It triggered freezing temperatures in Texas, heavy snow in the Midwest, and flash flooding in the Northeast, suggesting that people had less money to spend in January. Well, that moves forward into the coming months as people then cut back because they had less income. You cut back, inflation comes down. That means, of course, demand at retailers and wholesalers goes down, and you need fewer employees. Factories, you need less. It starts to snowball very slowly. But let's head over to Zero Hedge. They say what's notable is that once again there was a huge dispersion between the establishment and household surveys. While the former indicated an increase of 353,000, the latter reported a drop in employment of 31,000, suggesting again these two reports maintain opposition with each other. In fact, to the point that Zero Hedge points out here that the safe is to assume that the establishment survey numbers are now completely made up because they're showing continued increases in payrolls, while the household survey is saying, look, something is changing here. And not only that, but while the U.S. allegedly added 353,000 jobs, employment dropped by 31,000. Full-time jobs actually declined by 63,000. Part-time jobs surged by 96,000, suggesting that people are losing full-time jobs and going out and picking up part-time jobs just in an attempt to make ends meet. This is, again, not the sign of a healthy labor market, not the sign of one that's going to keep the Fed at elevated rates for longer at all. But what is going to help is a lot of people are going to be championing this, how great the labor market is. Be prepared for a lot of political elites to come out and tell you just how great it was, because before the revisions, what we were seeing is these downward revisions to the payroll report. So we see the actual release, and then, of course, the Bureau of Labor Statistics would come out in the months following and downwardly revise. Now, due to the annual revisions, they say, well, wait, we were wrong. Everything was way better than we thought. In fact, in December, it took payrolls up from 216 to 333,000. Of course, that kind of makes sense going into the holidays, but what doesn't make sense is this big number in January, because as we look at the non-farm payroll report, we can look then at total compensation, and we can see a wonderful relationship here, again, putting into question what really is going on at the BLS. Of course, we look at all employees now, total non-farm and change of persons is again in thousands. This is the exact payroll report. Now, I've cut off everything prior to just before the pandemic and after, because I just want you to see the relationship here between total compensation. Now, we know it fell off the cliff in January, but look at this. Where total compensation goes, payrolls follow, and it makes perfect sense. As employers are cutting hours and cutting wages back a little, wage growth back a little bit, you trim how many people you need to hire, and next thing you know, they get into a recession, it goes into contraction, which again validates the whole confusing part of this report. How do you see hours work slash, and yet employers hiring a ton of people? If we look at job openings labor turnover survey, well, we get a much better picture against total compensation. Again, total compensation leading the job openings and labor turnover survey, which makes sense because if you're cutting the hours of your employees and not giving them big of wage gains, well, that means demand's down, and that means you need fewer job openings. And sure enough, that's exactly what you see with this relationship here, suggesting that the JOLT survey is going to be coming down in a meaningful way in the months to come. And due to the long-term relationship between the JOLTs in the U.S. equity market, well, perhaps suggests the stock market is going to be heading the other direction in the not too distant future. But is there any evidence in the U.S. economy that any of this is accurate? Well, take a look at the recent manufacturing surveys, because what we find out is, well, it wasn't on the manufacturing side. Here, this from the S&P Global is the strongest improvement in manufacturing performance since September 2022, and we see a renewed rise in new orders, which is fantastic news. The seasonally adjusted S&P Global U.S. Manufacturing Purchasers Managers Index posted a 50.7 in January, up from contraction in 47.9, showing from December. Now, moving January, the U.S. manufacturing sector expanded slightly. The latest upturn ended the two-month sequence of decline, signaled the strongest improvement in operating conditions since September of 2022. And driving the uptick in the headline figure was a renewed expansion in new orders at manufacturing firms at the start of the year. I think this could have a lot to do with the Red Sea issue, as people look to purchase domestically instead of wonder when the goods they might purchase from Asia will actually show up. There's some evidence of that because the pace of growth was moderate overall and the quickest since May of 2022, where an increase was noted. Companies linked this to successful marketing initiatives and stronger customer demand. But notably, these numbers weren't huge. And that said, improved demand conditions were domestically focused as new export orders fell for the 19th straight time in the last 20 months. So it puts this in perspective. Domestic orders going up, export orders going down. Europe and Canada were identified by panelists as the key export markets with weakened sales environments, suggesting, as we know, the global economy is indeed slowing. In fact, employment at manufacturers rose fractionally in January, thereby ending a 3-month period of job shedding. Firms hired in anticipation of greater new orders, despite a further strong drop in backlogs of work. And what we can see here is none of this payroll report makes sense. At least it wasn't from the manufacturing side. They added a few people in anticipation things were going to get better, but they're chewing through the backlogs at a rapid pace. If new orders don't go up in the near term, well, look for manufacturers to start cutting these jobs in a big way. And one place that may be starting is in Chicagoland, because here we see the soft survey data collapse continues with the Chicago PMI. And today, this was from last week, we saw the same as it tumbled off of this weird spike and came crumbling down. Now, and notably, there is an upward trend here, but of course, the manufacturing sector is now back in contraction. Get this, new orders fell at a slower pace, employment fell at a slower pace, inventories fell at a faster pace, production fell in the direction reverse signaling contraction. Order backlogs fell at a slower pace, but still remain in contraction. Prices paid continued to rise, suggesting that what we know is a problem here. Prices are going up a little bit, but consumers can't afford them. But yet, many of you are wondering, but this is continuing to drive the equity market higher. Well, let's talk about why, because this is one case. I think the market's going to get this wrong in the end, but it doesn't surprise me when you're at the top. As stock bulls cheer signs the economy is ripping ahead, And today's job report calls into question the narrative of soft landing. This from David Donbian of CIBC Private Wealth. He said January jobs report was pretty dramatic, implying there may be no landing. Economy's ripping ahead. Well, I don't agree with that at all. And here we see Neil Dutt at Reconnaissance Macro Research says strong growth in labor productivity means unit labor costs are now under control, which is a good backdrop for corporate earnings. Hard to get too bearish here with such economic resilience. That from Brett Kenwell at eToro. In fact, Larry Tintori at Blue Chip Daily says data is a very bullish sign for the economy, and that we're buyers on any short-term weakness in stocks. Time to pile in. And just as many were caught off guard by the recession that never appeared in 2023, there's always a possibility that another year will go by without a recession. This from Chris Zaccarelli at Independent Advisor. That's the case. It's hard to see a new bear market starting without one. In fact, today's report reinforces the narrative this week that the Fed does not need to rush into rate cuts. According to Jason Pride at Glenmead, a March rate cut now appears to be increasingly unlikely. The more likely trajectory is 2 to 3 cuts this year, beginning around summer. Again, that's the reaction from the bond market today on all of this bullishness that the Fed has done the impossible. But we come back to where we started this with what Schwab had to say. Let's take a look. It justifies the Fed staying on hold? Well, maybe it doesn't. When you start to realize the total compensation, my friends, is crashing down, and that is not a good sign for the economy. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.